Everybody is talking about inflation, but I've been talking about inflation for over a decade now. Inflation didn't just suddenly creep up out of left field in 2021. Inflation has been the problem the entire time, except that central bankers and governments relied on inflation as the solution to their problem. In fact, for the last decade, the one thing central bankers seemed to agree on, whether it was in Japan or in Europe or here in the United States, they agreed that the problem with inflation was that there wasn't enough of it. We just didn't have enough inflation. Prices were rising too slowly, and that was a problem that the central banks were determined to solve. They were going to do whatever it took to increase the inflation rate up to 2% per year, because 2% was what they claimed was the holy grail of inflation, that inflation must be 2%, prices must go up by 2% every year, and if they don't, well, this is a huge problem, and the central banks need to solve this problem with radical monetary policies. Even if it meant negative interest rates, they would do that in order to make sure that the cost of living went up by 2% per year. Now, to average people, this would sound absurd. Why does the cost of living have to go up by 2% a year? And if it only goes up by 1% a year, why is that a problem? Why does it need to go up faster than that? Most people would rather the cost of living go down. If food got cheaper, people would like that. If their rent went down, everybody would love that. If your landlord said, hey, we've decided to cut your rent this year, nobody would object to that. What if, you go to the gas station and the prices are lower? Good news. What if college tuitions went down? What if medical bills, instead of going up, what if they went down, right? Everybody would love that. Everybody likes it when the things that they want to buy, the things that they need to buy, become more affordable. So why was it a problem for the central banks that the stuff we needed to buy wasn't going up in price fast enough? The way this 2% target came about was years ago. Many central banks began implementing 2% inflation as a ceiling. What the central bankers were telling everybody was that we're going to keep inflation below 2%. If it gets up to 2%, we're going to take action, because 2% is our ceiling. We don't want it to get above 2% a year. As long as it's below 2%, everything is okay. Gets to 2% or higher, we're going to spring into action to make sure it comes back down. Well, somehow along the way, that 2% ceiling became a target where central banks said, we need to get up to 2%. That was never their mandate. No central bank had a mandate of making sure inflation was 2%. It was just making sure inflation was below 2%. That didn't mean that if it was 1%, they had to try to get it up. They would just say, oh, it's 1%, that's great. It's below 2%, we succeeded. But they completely changed. The central bankers were faced with some serious economic problems that they didn't want politicians to have to deal with. Countries had run up a lot of debt. The governments really didn't have the ability to pay all this debt. And so what central banks did was lower interest rates to make that debt affordable by lowering the interest payments on that debt. And that allowed governments all over Europe, governments in the United States, to continue to pile on debt without having to make any difficult political choices of raising taxes or cutting spending. But also, because central banks kept interest rates so low, it wasn't just government debtors that were able to go deeper into debt. It was the private sector, corporations, individuals, everybody loaded up with debt. And the more debt everybody took on, the more the Federal Reserve and other central banks felt compelled to keep interest rates artificially low, because allowing interest rates to rise would have caused a financial crisis. A lot of people would have defaulted on their debts, including governments. And so the central banks kept interest rates low and kept printing money. Now, they called it quantitative easing, but quantitative easing is basically a euphemism for inflation. That's what it is. When the Federal Reserve launched quantitative easing for the first time in 2009, what it really decided to do was monetize government debt and create inflation. That's what quantitative easing was all about. It was about inflation. The central banks justified quantitative easing and negative 0% interest rates because they said these policies were necessary to raise the inflation rate. Inflation was too low. So central banks recognized that these policies were in fact inflationary because they were designed to cure the problem of too low inflation. But that problem didn't exist. All they did was pour gasoline on an inflation fire. Now, inflation didn't really rear its ugly head in a way that became a big problem until last year. And that's because these monetary policies operate with a lag. And what surprised me was the length of that lag. The inflation that we're experiencing now in 2022 really started in 2009, 2010. We haven't even caught up to the inflation we created in 2020. That's coming. Where we are today, you've got nations all around the world reporting official inflation rates at 8%, 9%, 10% or more, which means the unofficial actual rate of inflation is probably somewhere between 50 and 20%. So inflation is an enormous problem all over the United States. Look, I just got the other day a premium for my homeowner's insurance policy for my house I have in Connecticut, and it was a 38% increase over the prior year. I mean, that dwarfs what the government says inflation is. And the reason my insurance premiums went up so much is because they said the cost of replacing the house, if it burns down, has gone up so much. Because of the increase in raw materials and labor costs, it's going to cost 38% more to rebuild my house than it would have cost to rebuild the same house a year ago. That's what's going on in reality. See, inflation was the government's solution to the problem until inflation has now become the problem. So what is the solution to the inflation problem? There is none, at least none that is politically acceptable. And so inflation is going to get much worse. Forget about what these central bankers and politicians are saying about their commitment to fight inflation, how they're resolute and how they're determined no matter what to bring the inflation rate back down to 2%. That's never going to happen. We're going to see 20% inflation before we see 2% inflation. And this pretend war against inflation is going to come to an end soon. And the central banks are going to surrender and inflation is going to win. Look, we've already seen the first central bank capitulate and wave the white flag, and that was the Bank of England. The Bank of England, a week or two ago, was every bit as committed to fighting inflation as the Fed, until the inflation fight threatened a financial crisis, and then they cowered out, turned around, and they're back to quantitative easing. They went from quantitative tightening to open-ended quantitative easing. In fact, the Bank of England said, we're going to print as many pounds as we have to. We're going to keep on buying gilts. We're not going to let interest rates go up. They have to let interest rates go up. If you want to fight inflation, you got to let interest rates go up. But the other thing you have to do to fight inflation is to make government spending go down, because government spending is the source of that inflation. Governments are running deficits, and the central banks are monetizing those deficits by creating inflation. Cannot raise interest rates without creating a financial crisis. The financial crisis we had in 2008 was a result of a normalization of interest rates. It wasn't simply a subprime problem. The reason subprime was the problem was because it was debt. People borrowed money and they couldn't pay it back. Why were they able to borrow the money? Because it was cheap. The Fed lowered interest rates to 1%. They created a housing bubble. Housing prices went up. people borrowed money against those inflated property values. They borrowed money with artificially low interest rates. And when interest rates went up, property prices went down. People didn't want to pay their mortgages. You get a financial crisis because now the banks didn't get their money back. They loaned all this money out. They didn't get it back. That was why we had a crisis. Well, today we have much more debt than we had in 2008. We had 0% interest rates for almost 10 years. Think about all the debt that was taken on during those 10 years by not only the government, corporations, private citizens. Do you think they can repay that debt when rates normalize? Of course not. And what happens when rates go up, asset prices come down. It's like the other side of a seesaw. The lower interest rates are, the more expensive stocks are, the more expensive real estate is. But as interest rates go up, those prices come down because it's all a function of interest rates. So if I borrowed a bunch of money to buy a house and now the house goes down, I have no equity and my mortgage payments are up, I'm mailing in the keys. You see, when we had the financial crisis and then when we had the COVID crisis, inflation was still officially below 2%. So the Federal Reserve could get away with quantitative easing. They could get away with 0% interest rates because they were able to say we can do this because we don't have enough inflation. But when they try to do it again, when the problem is too much inflation, they no longer have an excuse for creating inflation. And when they try to do that, it's going to blow up because then you're going to have a dollar crisis. Then you're going to have a sovereign debt crisis. And that is a whole new level of financial crisis. And what that also means is that the investments that did well in the aftermath of the 2008 financial crisis, or the ones that did well during the COVID rally, none of those investments are really going to work out. Those types of investments, high multiple companies, companies that have no earnings, these companies are going to deliver losses. What you have to own as an investor are real inflation hedges. Companies that earn money today, not that may earn money in the distant future, because no one's going to pay for some potential distant future earnings in a high interest rate, high inflation environment. Even if the central banks are keeping interest rates artificially low on the short run, long rates are going up and inflation is going up even more. So you have to own real businesses. And because inflation is going to be so pernicious, consumers are going to have to cut back on just about everything they buy. And so what they're going to have to be buying are the products that they need, food, energy, things like that. So you want to own companies that sell goods and services that people have to buy, not what they buy after they buy what they have to buy, because they're not going to have anything left over for that. You got to get out of US dollars. You got to get out of US stocks and bonds. You got to get into precious metals, gold and silver, mining stocks, other natural resource companies. These are the stocks that haven't done very well on a relative basis over the last 10 or 20 years as the Fed was inflating this bubble. They're going to be the ones that do the best as the air comes out of this bubble.